I'd like to pose the next question to Hashim. If you start looking at the traditional asset classes, where else can you go to find this return, to find this yield in terms of building a portfolio? And also, a lot of the traditional asset classes leave you very exposed to the markets. And are there other ways that you can use additional alternative investments to diversify, for example? And really, how do you use them? And looking forward in 2021, where do you see the opportunities? And also, most importantly, as ever, where do you see the risks?
Thank you, Jason, for having me here. Thank you, Antoine, and good to be with you guys. Okay, so I think the question that you posed is important in the sense we've had a long run in markets. This is sort of perhaps the longest, and we all know that, and also the economic cycle have extended. But it is just the nature of markets. Anything you buy more of it, you make it expensive. And of course, now we have the driver, government, being sort of the driver of all of these things. Of course, having seen different cycles, this always worries you about what could happen. Now, the timing of it, becomes tricky, but we know that as more the market pushed up higher, the more sort of the returns squeeze. And so this then comes to the question, what could be done? Now, obviously, you mentioned alternatives, and alternatives is a broad definition of managers who can do something in the liquid space and managers who can do something in the illiquid space. And the liquid space, to me, it's no different than the instruments that were discussed. The only difference is that the manager has built the ability and the insights to be long and short anything, whether it is to hedge a portfolio or to construct a portfolio that can deal with different environments. Because the individual asset classes have biases. Equities would do well in a particular environment, and bonds would not do well in for example, rising growth and rising inflation. And the strategies, let's say, if you want to talk about specific strategies, you have, for example, global macro, which can be long and short anything. It is the most difficult strategy, but it is the one that can really provide a very stable return. At the other extreme, there is perhaps equity long short, which is being long Apple, let's say, and short Samsung, which will have plenty of opportunities in the world that was described. Going to the other side of alternative, the illiquid, which is the most illiquid being venture to private equity to private credit or real estate. These are really managers who, when they have locked up capital and they have the ability to change things, they go inside a company, they go inside a real estate to fix it, sell it, and then realize a return. Of course, this is a skill set. The average investor does not have, and also one has to lock up the capital. So all of these strategies that I've just described have a potential to earn more return than the traditional only. Now, obviously, I say this with the humbleness that we've had now 10 years in equity markets going up. And in fact, if you said to me, what was the best thing to do, I would tell you, just to be long equities or long FANG, and you didn't need to do anything. Now, obviously, we know the world of investing is not that simple. And that's why this discussion now is very important, because you are now going to ask yourself, how do I manage my savings or my money? And then you have the other complication, which I know it was touched on, about the inflation. So inflation, could be a blip or could be a real risk. And then, of course, the currency that you want to be in. Do you want to be in only US dollars, or you want to have a mix of currencies? And then which countries you want to be in? I think, it's last year was, to me, shocking how the gap between the performance of the UK stock market and the US stock market, huge. So these are all things to really one should worry about in his portfolio construction, to which obviously, alternatives provide an added value in that.
It's interesting, we've covered a lot of ground. We've gone from emerging markets in terms of fixed income, in terms of equity. We've gone from traditional to the developed market to the emerging space. But I want to come back to Hashim on alternatives, because one of the interesting things is there's a lot of places to go look for yield. Neil's spoken about real estate. We've heard, as I said just now, about emerging markets, etc., both liquid and liquid opportunities. Hashim, when you go speak to, there's a lot of managers out there that play in a lot of these different markets. I'd be interested in, how you choose strategies and how you choose alternative managers when you go speak to them and when you build your portfolios. And this is something that's certainly coming in terms of questions. People are very interested in, what more about what's going in the alternative space and how it comes into portfolio construction.
Yeah, I think, the choice of any investment should really follow common sense, in the sense, what has driven the performance. So, for example, the past 10 years, we know the equity markets have been going up. So if the manager is playing only in the equity side, maybe that's, the good reason why he had the performance. And ideally, the ideal manager is somebody who can play offense and defense. And defense is not basically against the benchmark to go zero. No, he can even go short, which is kind of really why the term hedge funds, or why alternatives. And in the illiquid space, like private credit or private equity, it's these managers who have the discipline to be patient. In other words, they don't deploy capital, just follow the herd. They go and select their areas. So, for example, managers who have been patient to deploy capital got rewarded and continue to be rewarded because they are providing rescue capital. So while the real estate guys who just wants to go and buy a real estate just like everybody else, it's the guy who goes and finds somebody who has a shortage of cash, and he goes then and either buy it from him at a discount, or actually give him rescue finance or control for distress. And the same thing with the private equity, so to speak. So for us, understanding where is the source of the return it's coming from is very important. Does the manager have an ability to play offense and defense? Has the manager, of course, lived through tough environments? See, to me, the highest grade of an investment manager is somebody who lived through crisis and survived them. Because that really tells you about their ability to manage risk and what did they learn from this. And by the way, the survival rates in managers is very low. Like, you get to hear about the successful guys. You don't know how many people have died, so as to speak. And then I think, finally, one has to appreciate what does it take to do all of this. In other words, to just like Fab is what does it take to build a bank that has the trust, the risk controls, all of that stuff. You have to also appreciate what does it take to build the know-how. I think, the previous speaker spoke about how, the selecting of stuff and what have you. Now, obviously, the world we're living in is a very competitive world. The world of data science, the world of artificial intelligence, and all of that stuff, which again, to build firms who have that ability to track all of this is not easy. Leave aside, of course, making sure that the firm culture, the team, everybody is together. So we are very particular on ensuring that the firm culture is very well thought of. So that's why when I said at the beginning it's common sense, because in reality, yes, you want to really see somebody track record. You want to see sort of how is he looking at the globe. For example, to me today now, when we hear our managers are underwriting assumptions to different environments, they're worried about inflation, they're worried about deglobalization, they're worried about government changes in regulation, whether it's with regard to tax. This gives us an idea that the manager is very much immersed in what's going on, and he is conservative. Because to be honest, since 2009, March 2009, which was really the bottom of the markets, we've had it easy. We've had it very easy, And in fact, last year it was a reminder for us. We didn't get a chance to blink, and the government came in and bought everything. we know that this is not real life. And so now you have to worry about what would come next. I think, if you ask me, the reflation trade will continue, and yes, but you have to worry about the returns you're making in real terms, which is after inflation. Because you could be making 15% on your portfolio, but inflation is very high. And no one knows really how this game will play out. So that is why, to me, when I look at how a manager is handling risk, it gives me a better idea about how they will behave. Because it's very easy for a manager to just go and buy the equity market and sleep. He will make. But the reality is, the more they understand the risks out there, the more they want to play both offense and defense to manage that. That's it, really.